Dear learners, welcome back to your educational channel Learn and Educate, where we were studying about the Income Tax Act as per 1961. The Act of Income Tax passed in the 1961 deals about the consolidation and amendments which relating to the law of income tax and super tax. In this video, we will be studying about Section 2, Clause 42B, short-term capital gains, wherein the short-term capital gains are the gains which is arising from the transfer of a short-term capital asset. The short-term capital asset in means as per section 2 clause 42A. Short-term capital asset are those assets which are held by the SSC for a period of less than 36 months, wherein the other type of assets which are considered as a short-term capital asset as per the Income Tax Act 1961 are the listed equity shares, wherein the securities transaction tax has been paid. In that case, when that asset is held for 12 months or less, then it would be a short-term capital asset. When the units of equity-oriented mutual funds are being transferred by the SSE for a period of 12 months or less than 12 months, which in if he has held the asset for less than 12 months, wherein the units of business trust, the real estate investment trust, and infrastructure investment trust are held by the SSA for those units. The units of those business trusts are held by the SSA for 12 months and less than 12 months, then it would be a short-term capital asset. When the units of Unit Trust of India or units of debt-oriented mutual funds are held by the SSA for 36 months or less, then it would be short-term capital asset. When the immovable property, that is land and building, held for 24 months or less, then it would be a short-term capital asset. And where the listed shares are held by the SSE for 24 months or less, then it would be a short-term capital asset. Therefore, when all these assets are transferred by the SSE, when all these assets are transferred by the SSE, which are short-term capital asset, then the tax arising on the capital gains from those transfer of the short-term capital asset would be short-term capital gains, wherein the full value of the consideration received on the transfer received as a result of the transfer, when the consideration received or acquired as a result of the transfer, then from that the expenditure would be subtracted, which are incurred exclusively for the purpose of such transfer. Moreover, the net consideration would be subtracted from the cost of acquisition and the cost of improvement. The amount received would be short-term capital gain. Therefore, the short-term capital gain is arrived after the full value of the consideration received as a result of transfer is subtracted from the expenditures which is incurred is in connection with the transfer, and then from that the cost of acquisition and the cost of improvement are subtracted to arrive at the amounts of the short-term capital gain as per the Income Tax Act 1961. Therefore, the income which is deriving as a result of transfer of the capital asset, the asset which is the short-term capital asset as per section 2 clause 42A, and from the transfer of the that capital asset, the gains arising would be short-term capital gains.